Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for May 16th of 2022. Please see our disclaimer for important information. Well, after a week's hiatus, we are back with some high-frequency data for you from our friends at First Trust. You can see kind of the continuing impact on demand out there. We see hotel occupancy, open table. Those numbers are a little bit weaker. Gasoline, a little bit weaker. We continue to see improvement in the TSA checkpoint data. I think that's indicative of business travel improving somewhat, but the consumer-oriented areas seem to be slowing down a little bit. We also see a little bit of a downtick both in the week and the month in rail car traffic. That has a lot to do with commercial goods eventually sold to the consumer sector. Again, another function of weaker demand overall. And of course, we know very well that the labor market remains extremely tight. We've got quite a few different economic charts to kind of get caught up on here. Some data points that we heard over the last week include PPI, which we'll talk about later. In the chart pack, we also have some CPI breakdowns, consumer price inflation, consumer price index rather, inflation data. And here's a sentiment number. This is the University of Michigan consumer sentiment number, and then the expectations index. And you can see on kind of a linear basis, both are trending down. Now we did have an uptick in the reading last month, but this month it was meaningfully below expectations. You can see the general trend line was up over multiple years until we got to the pandemic, and then we had obviously the recovery, and then with the inflation fears, as you might expect, because the Michigan sentiment number is heavily influenced by inflation, meaning that the survey itself digs in pretty deep to respondents' feelings on inflation. And obviously right now we have high inflation, and so you would expect sentiment to be weak. Now obviously what we want to do here is we haven't seen this weak a number since 2011, and we want it to kind of flatline out and at least not go lower. So obviously we'll have to come back in June for the May reading and get a better sense of where we are. Again, if we have hit peak inflation, you would expect that number, these numbers to kind of flatline a little bit. If you have more evidence of inflation kind of moderating, then obviously these numbers would likely improve. Here's buying conditions for large household durables, and so this is another one of these survey type questions that get asked, and so this data is from Bloomberg, but there's several different entities that survey this type of information. You can see that sentiment level is as weak as it's been since the early 1980s, again, at a time where we had outsized inflation. The only time that we've been close to this was in 2008, 2009, and that was where availability of credit was called into question by the financial crisis. And so where we are now is really this large outsized inflation and the ability to not only, perhaps in some cases, obtain financing, although that's really not the issue here. It's just prices are high. Now, it's kind of a flip side, there are puts and takes to just about every story, and we have seen the commodity basket really move higher of late, and seen some really strong spikes in prices for construction materials and industrial commodities, industrial metals for sure. Here, in this case, it's lumber. Obviously very important to the health of the housing industry. It's very important to the health of home buyers who are chasing product that has escalating cost factors involved. And so you can see lumber having traveled well north of $1,400 a thousand board feet as recently as February, March, but that number has come back down, and we saw a noticeable downtick in the commodity indicator for lumber here just recently. Now we've got two different kind of breakdowns for CPI coming up here. Now this one comes to us from Compound. It shows you the year-over-year change of the April report, which we just got reported to us this past week. You can see the year-over-year change in fuel oil, gasoline, very strong. We know that. We see it at the pump. Gas utilities, that's natural gas. We absolutely see that. Food, we know that we see that at the supermarket. Food away from home, food at home, electricity, all these components are higher. And so, again, this feeds into the consumer sentiment number that we just talked about, and it's shifting priorities for purchasing from more discretionary items to essential items that you see here on this slide. So here's taking a kind of a different look at it. So this is essentially the month-over-month change. And so obviously year-over-year, we know that there's strong gains in most of the primary categories. But when you look at it over the last month, obviously you see airline fares going up. That's intuitive because we're seeing more TSA checkpoint data. There's more demand for air travel, so you'd expect that the fare increases would kind of follow public transportation. More people are getting mobile. Now, eggs, margarines, those types of things are still going up. Chicken, there's still a lot of the food elements that are continuing to move higher here. And that's obviously something that we want to watch very closely because that is intrinsically important, particularly at the middle and lower income cohorts when they get stuck having to pay a greater share of wallet, what they earn for these types of essential items, then it really becomes hard for the consumer engine to move forward in earnest. But see on the flip side, televisions, women's suits, laundry equipment, smartphones, gasoline. And it's interesting to say gasoline in here just because gasoline's been so high. Now this is a month over month, so it just means this data can be volatile, and just in this particular month we did see a drop in gasoline. That's not to say it won't go up if we were to look at this 1 month from now, but needless to say there are elements that are going up, elements that are going down. It's a rather inconclusive picture right now insofar as what the trend in inflation looks like, and we'll talk about that PPI and the CPI numbers that came out and how they really didn't give the market a warm fuzzy that we had seen peak inflation, although the core numbers were lower. But we're still in this kind of this period of flux right now. So this is a chart you kind of identifying these sticky sectors. When I say sticky, I mean the cost of essential goods, food, but particularly labor and rents, wages and rents. And you can see in that blue area that blue area is becoming a larger contributor to the total inflation picture. And you can see in that amber line, that's just everything else, the basket of everything else. And so sticky price index contribution has moved higher. And so this is just simply reinforcing the point that you've got elements that aren't transitory that are going to be with us for a while. Again, I really do think like the investment markets have priced that in fairly efficiently right now. Not to say that the markets are not can't be volatile going forward, but there's a large expectation that there's going to be this sticky element that's going to stay with us. It's going to keep inflation higher than we've been used to. And here's a couple of other things that we see. Again, there's, as I said before, there's puts and takes to all of this. So where we have seen demand be very weak for apparel, and then we saw cost inputs move materially higher, and obviously container shipping, logistics, all that stuff. So we saw a corresponding spike, and now we're seeing the consumer price index that's tied to apparel roll over again, which is really interesting. And so you see that happening a little bit too in household furnishings and supplies. So the point is that not everything is moving higher. And even though there is some volatility in certain elements of this, that that there are some areas of the inflation basket that are actually moving in the direction that we want it to. So we'll talk about housing here for a second, and this is the Freddie Mac 30-year conforming fixed mortgage, and we're up at 5.3. You can see that has moved materially higher. So not only is this, hurting the refi market, it's also hurting the homeowner that is the owner-occupied variety, and in a good sense is also hurting the investor. So here's one area of the residential real estate market that has contributed to home price inflation, aside from easy money, liquidity, all those things, is the fact that we've had a lot of investors, and those folks are coming in with cash. They're cash buyers. It's not their primary home. They're buying it for investment properties, and they're looking at their cost of capital heretofore has been extremely low. Well, that's obviously changed. So these mortgage rates are now 5.3, and what it's doing is it's making that economic return that an investor would expect to make on a home transaction, if they're just buying it as an investment or a flip or trade or whatnot, that is not as nearly as compelling an investment now as it was even just a year ago. And so in a good way, you're getting some of those people out, which I think will take off some of the froth in the market. And these mortgage rates, it will certainly take the froth off the market. And so maybe we don't have outright price declines, but the rate of gain in home prices should certainly stall looking at this chart. So we know that with home price increases that rents usually follow, and that is absolutely the case here. And so now we have, from April, we have almost a 5% increase in rents. And that's the largest number we've seen. You go back to 1987. So this is a long time. So rents have certainly caught up here on the bandwagon with home prices. I do think that this is going to be, an ongoing issue. And really, who's getting hurt in all this is the first-time home buyer. And I think in many markets, you're going to see kind of, I'll call it the flatmate approach, where you have maybe a 2 or 3 bedroom unit that's not going to be single renter occupied. It's going to have, multiple people. It's essentially what you see in some of these highly densely populated areas like New York City and Boston, even parts of LA, where you see essentially multi-tenant renters. So now we'll dig into the PPI, the Purchasing Managers, producer price inflation. And when you look at these two numbers, one on the left is the all-in survey for PPI, producer price inflation. You can see that was 0.5%, and that matched the estimate of essentially half a percentage point in that month alone. And so if you look at it, if you look at the core, strip out food and energy, that number was 0.4%. And so this is where I think the markets did breathe a slight kind of sigh of relief here, in that the market was certainly expecting core inflation at the producer level to be much higher than it actually was. Not to say that we're out of the woods, certainly not to say that 0.4% is pretty light, because if you look on that chart, on both charts actually, and you look at it relative to really the last 7 to 8 years, you can see that we're still posting monthly gains that are still pretty robust, but obviously compared with recent history, we certainly have seen a downtick in the rate of gain in inflation. So in a couple of areas that really stand out from the PPI report, private capital equipment. Now those prices have moved materially higher, so we're seeing this rotation now into equipment. And then warehousing and transportation prices have really gone up for producers. And again, the one on the right has probably as much meaning as anything else, is that that's a real-time pass-through to the channel. So if your logistics and warehousing costs are moving higher, the chances of that being at least attempted to be passed through to the end consumer is relatively high. Now, private capital equipment costs moving higher generally kind of manifests itself in longer term pricing, but clearly that's something that we want to monitor here. So, I try to look at the silver linings on all of this. So producer price inflation, moderating in the last monthly report, but still relatively high. On this side, we've got US PPI in the black line, you can see where that's the rate of gain is kind of attenuating a bit. So you see that beginning to kind of flatten out. But what Pantheon Macro does in this chart, which is really interesting, because there is a pretty good relationship, a pretty strong causal relationship between these two. So China's PPI, again, a producer price index for manufactured goods year over year, is rolling over. Now we know what's going on in China. They've got pandemic lockdowns, so we know that production is being curtailed, and then there's export restrictions, which are causing continued kind of logistical constraints for all product that's manufactured and shipped out of China. So we know that the PPI for manufactured goods year over year is rolling over in China. And so given this tight relationship, this actually bodes somewhat well for having US PPI roll over at the core level. And so again, if we look at that last chart, and so we know the last data point was, certainly half as robust as the prior month. And you look at this chart and you say, this tends to foreshadow by the shape and the context of the data here that you're going to have a rolling over in US PPI. So that's obviously something good that we want to continue to monitor. But again, if you have producer prices that are following down a little bit, falling down a little bit, that at some point you see that transmission into the consumer sector. So other things that we've been monitoring here, real wages continue to fall, and that's because even though you're getting wage gains, particularly in the service sector, and we know it's a tight labor market, they're still not keeping pace with inflation. So I think this is going to be something we're going to be talking about probably for another couple of years as we get inflation that's kind of settling out. I do think you're going to have what you don't want in all of this stuff is to have the wage price spiral, which, wages are higher, which increase costs, which increase pricing, which, increases inflation, and then workers demand more money to be able to, to be able to buy more goods. That's what they call that wage price spiral. And so you obviously do not want that. With real wages being negative, this is obviously something that we want to be careful about. But again, if you have attenuation in the rate of gain in inflation with wages continuing to move higher, the hope here is that you get this number flattening out and perhaps you get it moving back up, perhaps a little bit closer to that blue line on the left-hand chart. And then clearly just, you can see on the right-hand side that you've got, your employment cost index or ECI, wages and salaries, and then map that against the PCE, personal consumption expenditure services related inflation, that both of those are moving higher now. So this is an interesting development too, particularly over the last month as we've seen this heightened, consideration for inflation expectations and whatnot. But the 10-year U.S. break-even rate, this is the difference between the 10-year Treasury and the 10-year U.S. Treasury inflation-protected security. So this is the implied break-even rate, and we do see that the implied inflation rate, which this is akin to, has actually moved down. So this is a market that's pricing in a little bit slower growth overall. Global monetary policy, and this is the sum total of basically all of the major central banks. And you can see here that, what we're looking at is the, quantitative easing for all of these different banks. You can see the amazing increase, and this is global. This is not just our Fed. This is Bank of Japan, European Central Bank, and People's Bank of China. You can see all of that moving higher, and you can see, how this has influenced the MSCI All Country World Stock Index. So you can see that that has moved, in reasonable parallel. Again, it's not perfect. I'd say there's a loose positive correlation here, but now that that punch bowl is being pulled away, you clearly see the impact on the global investment marketplace. Rising cost of capital was interesting. I was going through some of this research and came across this work from the head of strategy at Fidelity. And for illustrative purposes, this chart only goes back essentially a year. And you can see in such a short time that we've had all of these components. Again, the cost of capital move higher. And so, availability of credit, in some respects hasn't changed that much, but the cost of that credit, if you get it, is certainly moved higher. You can see not only high yield rates have moved higher, we've seen those spreads blow out. The market kind of pricing in a credit slowdown, meaning that credits are going to get a little bit tougher. Maybe you see some defaults and things like that. The market is certainly pricing that in. Then you've got the Barclays aggregate, 10-year Treasury. Even the earnings yield for the S&P 500, you can see that earnings yield is moving higher with multiples and prices for equities moving lower. So this is something I thought was also interesting coming out of the Fidelity research. So this is basically isolating the top 50 names in the S&P 500 and then comparing it in relative terms to the bottom 450. And so we've had tremendous leadership of this index from the top 50. In fact, you could argue it's really more the top 5 to 10 that have really been plowing the field for us. But now, obviously, the regime has changed, and a lot of those high flyers, high multiple, they call long duration stocks have really taken it on the chin. And I do think that, we're going to be in a period where this type of environment changes a little bit. Now you can see the overlay of recessions here. And so, it does tend to foreshadow in some respects a recession. It could, and we may very likely, learn at some point later that we're technically in a recession right now. And we just haven't called it yet, because usually that comes out of the National Bureau of Economic Research, where they will actually date it based on their analysis. But, it would seem to reason that the high flyers are going to give way to the broader market. In fact, if you look at the performance of the equal weighted S&P 500, that is like all 500 companies given an equal weight in the index, it's performed much better than these high flyers. And this chart right here speaks to this whole notion of why we're kind of rotating towards dividend payers, towards high quality, some cases towards larger cap and stronger financial strength. Those are qualities that tend to perform much, much better in this environment. Well, here's a chart on margin debt, and in the green shaded bars, you can see FINRA, which is is a governing self-regulatory organization within the securities industry. And they're the ones who track this margin debt. You can see that it's grown and grown and grown, more speculation in the market overall. And then you overlay that with the red line, which is the S&P 500 large cap index. And you can see obviously that that's rolled over at the same time that margin debt has as well. And so, to identify this relationship, it's really, I think one begets the other. So I would almost call these kind of, in some respects, coincident type indicators, because the market moves higher. People are going to be inspired to move more into debt to leverage their investments, which in turn, that leverage helps to goose the economy a little bit. So when you see both of these rolling over, it is actually, in kind of a contrarian sense, a fairly healthy occurrence. You can see, that correlation there on the left is about 0.948. That's a pretty tight relationship there. So we're seeing both of these roll over at a time where obviously we've got weakness in the market. And I actually think that's an extremely healthy thing. So this is Helene Meisler's Saturday poll. Now, Helene is a market columnist, writes on investments, writes on the markets. And there's this indicator that she publishes. This is like net sentiment. And oddly enough, amidst all the negative headlines and the fact that we've got multiple weeks of the Dow losing ground, et cetera, markets just generally being weak overall, we had a tremendous uptick in net sentiment. And this is investor net sentiment, really in the last week. So it's kind of first little green shoot, if you will, that we've seen in terms of investor sentiment. Again, not consumer sentiment that we talked about earlier. This is just investment sentiment, with this notion that maybe we are close to being washed out with all of these investors that are just panic selling. Here's another chart indicating hedge fund gross exposure to the equity markets, and you can see that that is falling below even its extreme baseline. So again, we saw this around the pandemic. We also saw this back in 2018 towards the end of we all remember the extreme weakness that we had leading up to Christmas Day on 2018. So those two events, we're in that territory now, and so this is actually a pretty strong contrarian indicator, because then hedge funds finally wash out. They're large institutional buyers. I mean, obviously much more powerful than mom and pop, even though there are more moms and pops out there. But hedge fund sentiment and hedge fund gross exposure numbers are actually pretty meaningful. And the fact that they're so low is in itself what I think is somewhat of a contrarian and positive type indicator. So here we have the S&P 500 plotted against real rates on a 1 month lag. And so, and obviously lower real yields are positive for stocks in the sense that the cost of capital is extremely low. The real cost of capital is in fact negative, and actually right now is, it just moved into positive territory. But you can see that relationship does tend to bog down equities. Now, as I said, there's always puts and takes in this, and so you've got a potential here of having real rates moderate. If inflation begins to peak and then just kind of begin to roll over, then inflation expectations, I think, will tend to get tempered a little bit, and then at the same time, you're going to have, continuing growth that's now being priced to slow down. And, some of these factors, which impact the calculation of a real rate may moderate, which I think in turn then gives potentially the S&P 500 the opportunity to begin to settle, find its interim footing here, and perhaps, move higher. We talked about this earlier, the price-wage differential. Again, we know that wages are moving higher, and really this is just a confirmation of the obvious that when wages move higher, there is some friction that makes it a little bit more difficult with wages to pass those along to the consumer, and I think as a result, we will see margins erode for the large cap companies. But again, that's very much expected right now, and it's being built into these tempered earnings forecasts that are still, frankly, 7 to 9% above a year ago. But it is reflective of margins coming down, and I think this chart with this relationship is very suggestive of that. So interesting here, we've got equity fund flows, ETF equity fund flows, in fact, have really been negative. So this is one of those things that you look at to kind of begin to understand, is the market washed out? Have we gotten rid of all of the investors that can't stand the heat? And you see that these outflows are actually fairly strong relative to essentially the last handful of years. Now, is it possible to have more outflows? Absolutely. Have we seen a quote-unquote capitulation yet? I'm not sure of that. But these are the types of things that you look at when you start to begin to ponder whether the market might be kind of basing itself, and then potentially with the opportunity to move higher. That'll do it for this week. Hope you've enjoyed the broadcast, and hope to see you again soon. Take care. Bye-bye.